Today, well, are rates really going up? Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news with a distinctively Australian flavour. Today I'm joined by Steve from Canstar. Hi Steve.
G'day Martin.
Good to have you back on the show. Thank you very much for spending some time. Now the Reserve Bank yesterday kept the interest rate where it was, are tapering the bond purchases slightly and basically saying don't expect much to happen for the next 3 to 4 years. So what's your read compared with what the banks themselves have been saying about the trajectory of interest rates?
Yeah, look, I must admit, I agree with the banks. I think interest rates are going up faster than the Reserve Bank is saying. And I know that they've, they've tempered the language a little bit, but they haven't tempered for 3 years. The banks are now saying, look, bring it back a year. Some are saying bring it back to the end of 2022 or something. And I think it will go sooner, and I think it might go by more than even some of the banks are saying. We're already seeing, now I'll give you some of the data from Canstar's database because we track this stuff all the time. And in May, we saw, in March, April, May, we saw a lot of increases going through to 4 and 5 year fixed rates. And almost every provider, I think it was every provider, bumped up their 4 and 5 year rates. The May was something that changed again, and that is that 3 year rates also started going up. And so sure, some went down as well, but a lot of them, a number went up, and the increases outweighed the decreases. Now, this tells me that the worm's turned, the cycle's changed, and it's only now a matter of time. Now, is it 2 years or is it 3 years? Well, it's one or the other, but the cycle has changed.
Right, and of course it's worth reflecting on two things. Firstly, the term funding facility stopped in June. That's the really, really cheap money from the Reserve Bank to the banks. Now, of course, they've got 3 years to pay that back, as it were, but it means that they're going to have to start accessing more expensive money later. So that's the first thing. And the second thing is, of course, that the international markets are also reacting to what's going on globally. And again, we're seeing some movements up. I know that the longer term rates came back slightly in the last few days, but what I call the implied forward rate, which is effectively the mathematical calculation of what future rates may be based on current rates, is definitely aggressively going up. And so I tend to agree with you. I think mortgage rates are probably going to go up. And in a way, it disconnects it a bit from the cash rate, doesn't it?
Yeah, look, it does. And it might be one of those occasions when the Reserve Bank actually loses the argument with the market and the market leads the Reserve Bank to an increase. And I think that will happen. But I think what people should realise is that fixed rates always move ahead of variable rates unless there's some shock to the system. So you'll see the fixed rates going up. So we've already seen 4 and 5 year rates going up. We're starting to see movement up in 3 year rates. Next cab off the rank will be, well, the rest of 3 years and then 2 years. And then eventually we'll get to a cash rate movement and we'll get to variable rate movements. But we are seeing what you'd expect to see. Fixed rates go up first because there's anticipation of growth in the economy, more inflation and less unemployment.
Right. And so that begs the question then, isn't it? If you're sitting on a mortgage at the moment, a fixed rate mortgage, and it's coming up for renewal relatively soon, right? Do you go fixed? Do you go variable? And if you're thinking of getting a new mortgage, do you still try and lock in one of those so-called low rates, or is it too late?
Yeah, there are lots of unknowns at the moment. But you know what? You're spoiled for choice right now. Plenty of people actually fix their rates at the top of the cycle at 7 or 8%. Then there's a rate decrease and then a sustained down, and they're locked in, they're stuck. At the moment, you're spoiled because there are great variable rates and there are great fixed rates. And if you fix, you're fixing at the bottom of the market. If you're staying variable, you'll still be low for a couple of years. So spoiled for choice. I think it's a tough call, though, deciding exactly when to go. And, I'm sort of for, fixing maybe for 2 years and then hopefully getting a second bite of the cherry before rates really rocket. But you've got to be conscious of the fact that rates will, or fixed rates, to fix again after 2 years, in 2023 will actually be higher than variable rates then, and higher than they are today, I think. But at least it gives you two bites of the cherry, and you can look at it then and say, well, we look as if now we're definitely on the way up, maybe fix for longer next time round. So it's a pretty interesting choice. You could fix for 5 years now and say, at least I'll get a few years of really decent rate when other people are watching theirs go up. But, you're already paying more. You're paying sort of 0.5% more than you would to fix at 3 years or at 2 years. So, I sometimes take the bird in the hand and say, look, I'll grab that one because it's there right now. I'll enjoy that over the next 3 years or 2 years and then really review it again. Say variable, you pay on average more than you'd be paying for fixed, and that's by about 1%, but that's on average. And that's a lot to pay for the privilege of flexibility in choosing when you can move. So I think there's a lot to be said for fixing at some point or other in the next 6, 12 months, but making that choice is tricky because none of us really know exactly when rates will have moved right up.
Right, and of course it's also worth reflecting on two things here. The first is that if you have an existing fixed rate and you decide to break it to try and reset, you're going to have to pay a cost to do that. So almost always it's uneconomic to break a fixed rate. The other one is, of course, that means there's a flexibility question, right? So if you are locked in for 2 or 3 years, then you're locked in for 2 or 3 years. And whilst it gives you an insurance against rates going one way, if your personal circumstances change, then you perhaps have a bit less flexibility.
You absolutely do. With most fixed rate loans, you can't make extra repayments, or if you can, you're quite limited as to how much they are. Now, at the moment, you should be saying rates are low. With what I can afford to pay, I should be getting ahead because rates will be higher in the future. I'll have to pay more in the future, and it's harder to get ahead then. So you don't want to lose that flexibility. Now, look for a flexible fixed rate loan if you can, but it's harder to find. Or put aside 20% or something, or 30% if you're ambitious, into a variable portion where you can make your extra repayments. So you get the best of both worlds. But you're quite right. To break a fixed rate today is going to cost you money unless you took it out in the last few months, and that would be kind of weird to do. But if you took it out a year or 2 years ago, it will be at a higher rate than the rates prevailing today, and you'd be up for what the banks call the economic cost. So you're compensating them for taking away a high earning asset that they funded at high prices, a high earning loan that they funded with their deposits, etc. And it's costing them a continuing amount on those deposits or that funding, but they've only got a low earning loan that they've replaced it with. So that's the economic cost that you'll be up for. The beauty of right now, though, for somebody who's on variable, is that with rates as low as they are and only 10 basis point bill rate and cash rate, you're unlikely to be in a situation where in the future you're up for a big economic cost because we're virtually at rock bottom. So you're at the point where you can say, well, I don't think I'll ever be up for that, even if I lose my job or even if I fall under a bus or something. Even if I have to break the loan for whatever reason, I'm unlikely to be up for one of those big economic costs. So it's sort of a very comforting thought to say I can take the lower rate by locking in, and I doubt that I'll ever have to pay an economic cost. Now, there's never any certainty in the world, so don't come back and blame me if something weird happens and we end up in huge negative rates. But I think you'd agree it's unlikely that you'll be up for that cost.
No, absolutely, yes. When you're at the bottom of the cycle, the economic cost works the other way. By the way, they don't pay you.
Yeah, I was going to correct you there. It sort of works the other way, and it should work the other way, but it doesn't quite.
Yeah.
But at least you don't get hit with a penalty. The bank says, oh, whoopee. Someone's
exactly. They bank the profit. Funny that. And the other question I had for you was looking at the pantheon of different providers there. How do the big guys compare with some of the small guys and the non-banks in terms of relative rates?
Yeah, well, let's talk variable first. the non-banks are still leading the market. If you pull a list of the top 10 rates, most of them are non-banks or sort of the challenger banks, the overseas challenger banks, for example. The reason for that is that their funding virtually is wholesale funding. It's those mortgage-backed securities that they use for funding, and they've been very favourably priced for a long time. And of course, their overheads are low and all that stuff. So they've led the market on variable rates. The big banks, for example, have some good rates for no frills loans, but their package rates are, frankly, they're out of the market. They're 3.4, 3.6, that type of range. And that's out of the market. So, the big banks are expensive there unless you get into one of their basic loans, which are okay, but not market leading. It's a little bit mixed there. Now, the big banks have good rates, though, in fixed. They've managed to keep rates below 2% for at least one term, mainly the 2-year term. I think Westpac has 2 and 3 years, and the others are just the 2-year term, which is below 2%. Now, that's a good rate, but you can get down to 1.67 or something, or 6.9 with a non-bank. So there are some better rates around, but then anything below 2% is a pretty good rate. And so they're okay there, even though, again, they're not quite market leaders, but it's nothing like their package rate compared to the lowest rates in the market, which is 1.5% difference is huge.
Yeah, and those are big numbers, right, in terms of the amount you pay on a monthly basis, which is why, of course, a comparison site like Canstar is so important, because you can see all the different variable and fixed rates that are there. I guess the other point to make, which is really important, is that there's a difference between the headline rate and the comparative rate. And that's something else that people sometimes get tripped up with.
Yeah, now what it's meant to do is show the all-up cost of the loan. So when you take out a loan, you usually have fees as well as the interest rate. So the comparison rate, except in about one rare case I've seen, is actually higher than the variable rate, than the actual headline rate, but normally just by a little bit. Now, if you see one that's sort of like 0.3, 0.5% up, it immediately sets off these warning bells that say, danger, danger, warning, warning. You are probably up for high fees here, so explore the fees and say, whoa, that's a high fee, I don't want that loan. But there is an anomaly, a couple of anomalies, but the main anomaly is for fixed rates. And the fixed rate will have, in a lot of cases, a comparison rate 1% or 1% plus more than the headline rate. And that's because the 3-year fixed period is set at the actual rate. And then after that, the loan reverts to another rate. And that's usually a significantly higher rate. In some cases, it can be as high as the bank's standard mortgage rate, standard variable rate, which they don't use anymore except as a benchmark. So, and that can be over 4%. Now, that says a couple of things. It doesn't say don't take out this loan, but it says treat this loan as 3 years. And after that, you've got to do something and you don't waste too much time. So when you get to the 3 years, well, a month before you get to the 3 years, you start talking to the bank about your options. And you say, I don't want to be on that horrible revert rate. I want to be on one of your better rates now. I want to refix, or I want to go variable in a basic discount. If you can't get satisfaction, you go somewhere else, because there'll be better rates around, provided you've been making your repayments all the time. So just don't ever allow a loan to fall off its fixed rate term without a plan in place. Now, it's not all loans that are like that. Now, the other funny quirk about this, and our founder had some play in designing this, and it was okay at the time, but it's designed for a $150,000 loan over 25 years, and it's out of date by a margin, by multiples. Now, that's not Andrew's fault, because he did this 15 years ago or something, maybe longer. But it's nevertheless, it's only an approximation, because at 150,000, without going into the maths, it does overrate the effect of the fees.
Yeah, absolutely. But again, caution to people looking. Don't just take the first level number that comes up. Do a bit of digging. Ask a few important questions so you really understand what you're getting into. And the fact that you can, if you're not careful, fall off the end of a fixed rate loan and then go up to a much higher rate is something that many people don't really understand and don't even necessarily know when precisely that event's likely to happen. Now, I think the banks are meant to tell you and give you options, but I have seen of cases where they don't do that.
Yeah, I've not myself, and I've used both, and I've not heard that, but I wouldn't be surprised if every now and then there's one slips through the cracks. They do tell you that it's coming up. They're not always totally convincing in offering you the options. So I'm sure if they felt they could retain your business at that huge revert rate, they'd be, okay, if you insist, we wrote to you.
Yep.
So I mean, the other thing though, Martin, is look, they should write to you, and I think most times they do, but treat that not just as a time to talk to your bank. Treat that as a time to explore the market fully. Go to the Canstar website and look at what else is around, because the chances are you won't be offered the best rate if the expectation is that you'll just roll into another one of their loans. Chances are you'll have to negotiate a bit harder than that.
Yep, the old apathy tax strikes again, right? So do the work. It's definitely worth it. And so to sort of bring the conversation to a bit of a close, rates are probably going to go up. It's hard to know precisely how and when and in what form, but be cautious, ask all the right questions, get as much information. If you do that, you'll make the best possible decision.
Yeah, that's right. I mean, the unwary, the unprepared are the people who pay too much. Almost irrespective of which bank you're with, there are good rates at that bank, and make sure you're on one of their best rates. But before you say, yes, I'll take that offer because I can see that's your best rate, look at some of the alternatives, because an extra 0.2, 0.3% makes a difference of, sort of $50, $100 on your loan repayment every month. And that's easy money to save. You don't have to do without anything to actually save that money. So it's worth a lot of effort there rather than skimping on your grocery bills and saving a third of that.
Absolutely, yeah. These are big numbers and it can have a big impact. So be cautious, be careful, and if you follow Steve's advice, you can save some money. Steve, I appreciate your time today. We'll put the links to Canstar below, and I'm sure we'll pick up the conversation again down the track.
Terrific. Great to catch up, Martin.
Thank you very much. See you later.
Cheers.